Good morning, it's Remon Vos with the Q1 2023 results. Welcome to all shareholders and analysts and the community. Happy to share with you strong results for the first quarter of 23. We've seen similar trends as we have seen during 2022 with continuous strong demand from our more than 1,000 tenants. And that resulted in us signing leases with a total lettable area of 300,000 square meter during the first quarter of this year. The good news is that we've been able to sign that at an average of €5.31 versus €4.87 during the same period last year, Q1 of 2022. We will continue to further accelerate leasing in April. So that's positive when it comes to the leasing. With respect to the income producing part of our business, we have been able to increase rent like for like at almost 8%, 7.8% compared Q1 23 compared to Q1 2022. I will continue to inform you on our three business units: the operator, income producing, the developer, our in-house construction business, and last but not least, our energy business. Let me start with the operator. We have under ownership almost 11 million square meter of gross lettable area. And with that, CTP is now the largest listed player by GLA in Europe. We have €628 million of secured rent for the next 12 months at an occupancy of approximately 94-95%, which is similar to what we have seen last year and the years before. And we stay close to our existing clients and tenants with whom we have been working for the past 2 decades. And we have been able to sign 2/3 of all our leases with existing clients. And these clients are more than 1,000 different companies, small, medium-sized, still multinational, some involved in manufacturing, others are logistics service providers. There's a whole broad range of different industries, but all good and healthy, growing businesses, mostly located in Central Europe. And these clients, they pay and they pay on time. We have been able to collect 99.7% of all the rent charged. So that's positive. With respect to Western European markets, I can also report good news, maybe a bit more detail on Germany, where we acquired the portfolio. The portfolio now produces around €66 million compared to €59 million when we bought it. So that's more than 10% increase, and we expect more increase going forward. We've also been able to hire some very talented people to grow our German team, which I'm super excited about. We have 50 people in the meantime with 3 offices, Berlin, Düsseldorf and Stuttgart. And we are well on the way to increase rent income from the portfolio which we acquired, but at the same time also start to develop new property, new buildings on the land which we acquired as part of the takeover of DIR. So in Germany, underway both income producing, the operator, as well as the developer. So far Q1 this year, CTP delivered a total of 223,000 square meter at around 10% yield on cost, a bit more. High occupancy, around 90% in the meantime of all the stuff delivered to the market this year. And that produces an income of around €13 million per year. That was Q1. In the meantime, we have under construction approximately 1.8 million square meter in 10 countries. And we expect that most of that will be completed this year and that we will be able to do similar or more growth as we've done in 2022. We will be doing that at 10% or north of 10% yield on cost because we've seen construction costs stabilize last year and come down a bit. At the same time, we also see a rental growth. Clients are willing to pay more for the space, and that gives us opportunities maybe even to increase that 10% yield on cost to closer to 11% yield on cost. We have big plans with the developer. We have a land bank of 20 million square meter, and that is mostly land within existing business parks, land with infrastructure, with permits, in parks where we have tenants and where we have people on the ground to continue build those properties, which we do in-house. And an advantage of that obviously is that we can, as an in-house construction company, accelerate or delay construction subject to demands, but also we can do adjustments to the properties in case that is needed for the tenants. So that's an advantage of having an in-house construction team on site in those business parks. And because of that land bank and the opportunity, we're confident that we can hit the 20 million square meter target before the end of the decade. More to report on the general contractor at this moment. If we would look at our energy business, which we are at the same time installing solar panels on the rooftops, that is a higher yield on cost, more towards 15%. Much appreciated by our tenants, of course, because that renewable energy becomes available to the tenants in the park. That's one thing I would like to report on the developer. Also, I did talk about Germany. I want to also highlight Poland, the largest growth market for CTP. Not a market where we have been for many years. We recently entered. We're currently 70 employees, and we have a lot of property under construction, a total of more than 400,000 square meter, in particular in the region of Upper Silesia, Katowice, Zabrze, but also in Warsaw and along the German-Polish border. Strategic locations with good progress on site, construction cost under control, and with a strong demand and good take-up. So we are closing deals and have been closing deals during the first quarter of this year, and we continue talking to tenants during Q2 and beyond. The Polish market has been dominated by trade developers. We have a different setup, so we see less supply coming to the market in Poland from other players, and that gives us an opportunity to increase rents and to lease the properties which we have under construction. So positive on Poland. As you know, very much involved in the new markets where I do spend time in them in Poland on a weekly basis, same as in Germany, and I very much enjoy working with those teams. I wanted to maybe highlight on a CEE paper which we have done in April. We operate in 10 countries, but CEE is for us the largest region, also the region where we believe in very much. What we see clearly is friendshoring, nearshoring in Europe, for Europe. All kind of businesses from Asia, European, set up shop in Europe, continue to extend their activities in Europe to supply the European market. And then Central Europe is the ideal location with lower labor costs, with brand new infrastructure, with government supporting very much all kind of FDI support programs. And that is obviously positive for our business, has a positive impact. And we see that continue and are confident and happy with that forecast and outlook. I hand over to Maarten and Richard later on, and of course available to answer any of your questions later. Thank you.
I will now run you through the main financial highlights. We continue to deliver on our promises with another set of strong results on the back of the structural demand drivers described by Remon earlier and historically low vacancy levels, while supply is tailing off, improving our competitive position. We achieved a like-for-like rental growth of 7.8%, driven by indexation and strong rent reversion. 52% of our portfolio is now indexed to the consumer price index, and the other 48% is with fixed escalations. By the end of 2023, we expect around 70% of the contracts to be linked to CPI. Our net rental income for the quarter came to €130.7 million, up 21.9% year on year, while the next 12 months contracted revenues increased 25.1% year on year to €628 million. Company-specific adjusted EPRA earnings increased 32.1% year on year to €78.3 million, while the earnings per share increased 25.2% year on year to €0.18. on track to reach our guidance of 0.72 for 2023. Moving on to the valuations. At the Q1 and Q3 results, only investment properties under development, which were significantly changed, are revalued externally, while there was no revaluation of the standing portfolio. The gross asset value of our portfolio came to 12 billion euro, up 4.5% compared to 31st of December 2022, driven by developments and acquisitions. The positive revaluation in Q1 2023 amounted to 208.3 million euro and was driven by development completions, which were with 223,000 square meter significantly higher than the 47,000 square meter in Q1 2022. Consequently, the EPRA net tangible assets per share increased from €13.81 as at the 31st of December 2022 to €14.44 as at 31st of March 2023, representing an increase of 4.6%. Looking forward, as said during the full year 2022 results, with the larger yield movements in Western European markets, the yield differential between Central and Eastern European logistics on the one hand and Western European logistics on the other hand is back to the long-term average. We expect the yield differential to come down even further, driven by the higher growth expectations for the CE region. In 2023, we contemplate the further potential yield widening to be offset by positive ERV growth on the back of continued tenant demand, driven by the secular growth drivers in the CE region. Rental levels in CE remain affordable for our tenants, despite the strong growth seen, as they come from lower absolute levels than in Western European countries. And now I hand over to Richard.
We have a robust balance sheet and excellent access to capital markets, as we've demonstrated by the different pools of liquidity we've tapped during recent months. Earlier this month, we raised 280 million euros of unsecured funding, increasing our pro forma cash position to 892 million euros, illustrating our access to capital and further strengthening our liquidity position. This brings our pro forma liquidity with the extended and increased RCF of 500 million euros to 1.4 billion euros, more than sufficient to meet all our cash needs for the next 12 months. In Q1, we concluded financings including a 95 million euro 7-year secured loan for an all-in cost of 4.3% and a 133 million euro 7-year secured loan for an all-in cost of 4.6%. The first tranche of our new unsecured loan facility was received from a consortium of banks. The 280 million euro tranche has both a 5-year and a 7-year maturity for an all-in cost of 4.7%. We expect to sign the second tranche of this facility later in this quarter. This facility allows us to diversify our sources of capital, as the bank market continues to price funding for the real estate sector much more realistically than the bond markets, with pricing that reflects the long-term and growing cash flows that CTP has to offer. We have a strong pipeline for additional financing, with a material amount of loans agreed, which we will draw over the coming weeks. In February 2023, we also increased our RCF to 500 million euros. This now has a new 3-year maturity with 2 1-year extension options. Our average debt maturity stands at 5.5 years, and we have a 400 million euro bond maturing in November of this year. This we will repay from available cash reserves. Following this, the next material maturity we have is not until mid-2025. Our average cost of debt stood at 1.6%, with 99.4% of our debt fixed or hedged until maturity. Thanks to our strong cash-generating portfolio, we have a healthy interest rate coverage ratio of 4.4 times, while our forward-looking ICR, including annualized income for our projects under development, comes to 5.3 times. And our normalized net debt to EBITDA is 9.7 times. Our loan-to-value ratio stood at 45.9%, slightly above our 40 to 45% target range. We expect the loan-to-value at year-end 23 to be around 45%. as the revaluations of the developments we have are booked. We continue to deem this range to be appropriate, given the high-yielding nature of our portfolio. We are confident in the outlook for CTP. Leasing dynamics remain strong, with robust occupier demand, low vacancies, and decreasing supply, leading to continued rental growth. We are uniquely positioned as market leader to benefit from the tailwinds for logistics and industrial demand in the business-smart CEE region. Our pipeline is highly profitable and tenant-led. Our yield on cost target for new projects is increased to 11%, thanks to decreasing construction costs and continued rental growth. CTP has the team, we have the land bank, we have the balance sheet, and we have the tenant relationships to continue to deliver on our promises. We confirm our guidance for the 2023 company-specific adjusted EPRA earnings per share of 0.72 and remain on track to reach 20 million square meters of GLA before the end of the decade. Thank you for your attention. We now welcome your questions.